very interesting first session where, the panelists discussed about, raising capital from LPs and, what are the important parameters that should be kept in mind. But once you have raised the funds, it has to be deployed somewhere. And there you get into the deal making and the investment part of a transaction. So in this session, what we are planning to do is we'll discuss the process of deal making and an investment, right? And what we'll try to cover in this session is, how do funds or VCP funds identify deals, and then what is the process that is followed for making that investment. So I will start with my question for Vinay. So so Vinay, when you once the fund is raised, right, you have to get into identify a target. So there are two ways, right? One is sometimes you identify a target and you would approach them for investments. Secondly, sometimes people approach you, and I think that's a lot more where I'm sure you get a lot of pitch decks, etc. from companies asking for capital. So how do you approach a deal making? What are the various parameters that you look at in terms of identifying the company that you would like to invest in?
Great question. Just so before I start, show of hands, how many people are from startups here? You just raise your hands. How many people from funds or buy side? And then how many from early stage focus, early stage investments, later stage? So it looks like there's a mix of things. So sort of shape our answers as well that way. Deal sourcing, golden question obviously. We do it through bankers, incubators, accelerators. I guess the one where we earn our paycheck is through proprietary deal sourcing, and that we sort of build our own thematic focus based on domain expertise, build an investment thesis, whether it's AI, whether it's nutraceuticals, whether it's healthcare informatics. We take a certain sector, dig deep, build an investment thesis, and we say, this is investable, not investable. What are the companies that are there in this domain? What's the competitive landscape? What's the margin profiles, growth prospects, things like that? Then we reach out to those entrepreneurs. So I think that part of the proprietary deal sourcing is sort of where we spend most of the time. Of course, there's inbound from bankers and incubators and accelerators and all of those people.
Great. So I think once that is you have identified a person, the next stage is signing a term sheet. Right? So first question to you on the term sheet. So finally, what are the metrics that you are looking for after you have spoken to the founders and the team, where you move to the term sheet stage?
Yeah. So between term sheet and sourcing the deal, could be anywhere between 6 to 8 weeks or a couple of years, right? Depending on how mature a sector is or a market is or a company is, right? Sometimes we've met companies which were very, very early on, nascent in their journey, and we said, this is very interesting. We like the team and the product, but we'll just keep in touch, and 12 months later, let's see if we can do a fundraise. Maybe there's a company which is mature in terms of their thinking, proof of concept, so we can go to the next stage pretty quickly. Even in that case, we probably spend about 6 to 8 weeks. We meet the team multiple times. We look at the market, we look at the business model, their approach to solving things. Do they have any traction? How early stage it is? If it's very early stage, then in terms of traction, there may not be much metrics. So we then look at what have they understood about the market? How is their approach differentiated to any other competitors that may be there in the market? And then I think most importantly at an early stage, it's about the team, right? How good is the team, their tech and product capabilities? How do they sort of respond to some of these key questions, and how deep is their domain knowledge, all of that stuff. And then we take a call, like I said, it takes 6 to 8 weeks, even longer. Typically, we tend to go to a term sheet only when we are completely convinced we will do a deal. We don't tend to issue term sheets and then sort of go back and sort of renegotiate things and all of that. We tend to, it needs to be as ironclad as it can at that point of stay, at least on the investment thesis and the company, right? So we tend to do a lot of work upfront and then go to a term sheet. And these are the sort of metrics we look at. So.
Thanks. I think that's very helpful. So, Abhinav, now that Vinay has decided to move to the term sheet stage, so as a lawyer of the fund, how do you approach your, drafting or negotiations on term sheet?
So, as Vinay said, most funds, including mine, move to a term sheet only after there is a strong belief in the team and the thesis. So, at least our approach is that, term sheet is not the be-all and end-all. The idea is to have a understanding on key commercial aspects, certain basic rights which need to go in, but we don't try and over-optimize in the term sheet. It's at the end of it an understanding of partnership. So our term sheet process is fairly swift and quick, and sometimes some of the issues which are faced at the term sheet stage are when people start over-optimizing, whether it's the company or the investment team. So basically, once the mandate's been given, our objective is to sort of get the term sheet out and signed in a couple of days' time, because a lot of things can be sorted out even after that.
Yeah. So what are the key things you would include in a term sheet? This rest can be discussed at the documentation stage. But what are the 2-3 things that you think parties should agree upfront before,
See, there are 2 things which are very important for the whole transaction, not just the term sheet, right? One is the sector in which the company is operating, and second is the structure which the company has. Now, any questions and issues around this should ideally be at least understood, not acted upon to sort it out, but at least understood and identified that these things need to be done. So apart from your regular ones of the investment amount, the valuation, those things, I think deal-specific things which come into a term sheet are around these 2 points. If there's a structural issue to be solved, it should be very clearly stated that it needs to be solved. And if there's a sectoral issue to be addressed, that needs to be stated. Beyond that, there are those regular templatized clauses like exclusivity, so on and so forth. One more thing which I believe everyone should be very particular about is to honor the term sheet. It's a non-binding term sheet in 99% of the cases, but for all parties who are involved, once a term sheet's been signed, the idea should be to honor it.
Yeah. And I think that's a very important point, because as Abhinav mentioned, these are non-binding term sheets. So, it's not a document that you can act upon or enforce, but, it is a gentleman's handshake, right? And once you have agreed and signed up to a document, whether it's binding or non-binding, you should go ahead and, discuss the documentation or the transaction in the same spirit, right? So, Abhinav, you mentioned valuation is one of the important aspects. So, Vinay, being a lawyer, valuations have always baffled me, and we keep reading that it's an art, not a science. And, I think, the things that comes to my mind is, how do you really value a company? What are the metrics that you look at, right? Because at a very layman level, any business, in my mind, should generate profits. Accordingly, you will get returns. But, with Flipkart exit, where a lot of early stage investors have got a very good exit, first time, as in one of the poster boy exits in the Indian scenario, right? So clearly, it's not only profitability that the funds or the buyers are looking at, right?
Right.
So in these days, what are those metrics that you look at from a valuation perspective?
That's a great question, right? Again, it depends on what stage the company is at. I think there's been a lot of talk about Flipkart getting a great exit, yet not getting to profitability and all of that. But I think what we have to do is step back and understand that the internet industry in India is pretty nascent, right? It's only 10, 12 years old. I mean, if you leave aside the early attempts in the early 2000s, 2007, 8 is when this thinking started, and 2010 is really when things started to kick off. If you look at China or the US as an example, profitability has been reached by even the large guys, say Amazon's, Alibaba's, but after a certain journey in the first decade of their evolution, right? So I think that way we still need to give it time. As everyone knows, India is probably an even more difficult market to conduct business in any shape or form, just because of the GDP and the demographics and all of that. So that part of it, I think profitability is important. More than profitability, I tend to focus on unit economics. If you're buying something from a person at a price of X and then selling to someone else at 2X, what sort of gross margins you make, and then what sort of direct costs and marketing costs and all of that. So what people term as contribution margin, right? And contribution margin again can be defined in different ways, but everything apart from the fixed sort of corporate costs, right? Can that start generating cash, right? And if you look at the Amazons of the world, the profitability has gone up and down over different quarters, but free cash flow generation has always been there, right? Because the unit economics are pretty good, and then they tend to take that cash and invest it into new businesses, new investments and all of that which is all fine, right? But the unit economics has to be strong. So I tend to focus on gross margins is at every stage, right? So at an early stage, it's probably proof of concept, and then unit economics and all. So valuation therefore has to come from that, right? You look at the growth rates in the revenues, GMV, GTV, whatever it is, right? If it's traditional businesses, then normal net revenues, right? And then sort of drive the valuation out of that. And then again, it's a question of geography. Typically, Indian market is growing very fast. Therefore, companies grow very fast. So you tend to look at all of that, right? And then factor that in. So we also do growth equity deals where we look at companies and base them out of EBITDA. So to give you an example, something in a healthcare manufacturing business in the US would tend to grow at 12 to 15% sort of rates, 15% EBITDA, 20% EBITDA margins, and tends to get valued at about 10 times EV to EBITDA. We might look at a similar business in India and sort of value that at 8 times EV to EBITDA, but the market might not be ready to take that on, right? So then we'll have to sort of look at what is the Indian sort of precedence there and maybe pay a higher sort of price for that. So I think it varies by geography, it varies by business, it varies by stage of the company. Flipkart got, based on the reports that I've seen, got sold at 2 to 2.5 times GMV. Whereas if you look at Amazon, which is pretty close to them apparently in terms of GMV, was valued at 2 times, or rather 3 times. I think it was a little higher. So it varies, right? And it's not like someone you were saying, right? It's not a science. So I think it varies by businesses. So for entrepreneurs, I would only say that don't tend to focus too much on that at an early stage of the business. What we tend to do at that stage is we say, you know what, if you're raising, let's say, $2 million, and typically an investor wants to take, let's say, a 30% stake or so, because you don't want to take majority because you want to give the proper incentives to entrepreneurs, but you don't want to end up with less because you want a board seat and some sort of control over what's happening on things. So that sort of gives rise to a re-engineered valuation of about 4 million of pre-money, right? That's the sort of math that works at an early stage, right? Whereas later stage, it depends on the metrics that I mentioned. So that's a long-winded answer to your question.
I think so. That was helpful. So I think once these are the first stage of the transaction is over, then we move to something called due diligence, right? So due diligence is basically a check, a health check that the investor does on the company, and there are various reasons for it. One is most of the funds own a fiduciary duty to their LPs, right? So they need to be sure that before they invest, there are no hidden issues in the company which may and come create issues for the investors or the company in the future, right? And also we have a legal concept called buyer beware. So before you buy something, you should check whether there are any problems with the product you are buying, rather than complaining later that I was not aware of this issue, right? So when a fund does diligence, they typically focus on 2-3 areas. One is the financial diligence. The second is the legal aspects of the company. And third is the business, which, as Vinay said, before they move to the term sheet stage, at certain level, they've already done that diligence, and they're convinced of the business model, and that's why we have moved forward in the transaction. So, Abhinav, my question to you, from a legal perspective, when you engage lawyers to do a diligence on the company, right, what is your instructions to them in terms of what they should focus on. So obviously, every lawyer has certain areas, there, because you can divide the operations of the company into various areas, right? Like finance, IP, regulatory, compliance, right? But what is your advice to them in terms of what should they main focus be on a diligence?
So, our first conversation for a diligence is not with the lawyer, but with the company. We actually, even before we rope in a lawyer to conduct the diligence, we actually reach out to the founders, have a conversation with them. Because what's most important for them to understand is, it's not a fault-finding exercise.
Yes.
We are not out there to get them. We are not out there to sort of go renegade on the term sheet saying, hey, this is the issue.
Yes.
As Vinay had mentioned, there's a lot of work which goes in. There's a lot of faith in the founder and the business before a term sheet is issued. So the idea of the diligence is to make things as right as possible, which is helpful for us as an investor and for the founders, because at the end of it, they are running the business. Their liability is a lot more than ours. And they are also, at the end of it, shareholder in the company. So the first thing which we do is actually speak to the founder and explain this to them, that it's not a fault-finding exercise, and so please cooperate. The second thing which we ask for is please come clean, straight up.
That's very important.
Let's not lead to a situation where we've spent 3 weeks doing the diligence and then something is unearthed. It's better if you've done some fancy structuring, if you've done something which you were not sure of, just tell us and we'll collectively try and figure out to solve it. If it can't be solved, we will again collectively take a call as to what to do about it. So this is what we do before we kickstart a diligence, actually speak to the founders and sort of lay it out for them. Then obviously, Nishith, Desai comes in and does the diligence. Again, it depends on the kind of company it is. But at least tech investments where we focus on largely, IP is most critical. So, there are certain hygiene factors in terms of whether shares have been issued, allotted, compliances, so on and so forth. But IP is something which we are very particular about, and I think to everyone out there, it's been my experience that people have been so busy creating the IP that they just sort of forget protecting it, and it's very, very important to take steps which are necessary to protect your IP. So that's something which is very critical. The second is the business contract. So, again, the general understanding is that legal diligence would mean just reading the contract. That's not how it works, right? There are 3 diligences happening. There's a legal diligence, there's a financial diligence, and there's a business diligence. And they all, at the end of it, need to sync up. Yeah. If your books say that there are 5 clients which you have to justify to me from either in terms of a contract, one way or the other, that there are. If your revenues are so much, then the contracts at the end of it should add up. So the business side of things is the second aspect, which is very, very critical. Then, again, another thing which sort of gets ignored are those basic compliances, say, for example, having a shops and establishment act. If you have more than 20 people, having PF registration. And some of these have big ramifications, I mean, it may seem a very small thing that, hey, you've not paid your PF dues, but it's a statutory due at the end of it. It's akin to not paying your taxes. So while they seem small, that's another thing which we focus on. Then something which flows from the term sheet is the cap table, and the sanctity of cap table is paramount. So, it's a big red flag for us if we've been told that this is the cap table of the company and then we discover it's not. So I think these would be the 4 key areas which we would focus on. But again, the most important thing is the first step of conversation with the founders, because it's important for them to realize that, we are not out there to get you. We are out there to partner with you and solve it with you.
Great, thanks.
I can add a couple of things.
Sure.
So just to add to those things, the other one we tend to do in terms of diligence sometimes, especially in early stages, technology diligence, where we may have to do code reviews and things like that and go deep into what has actually been built, who's building it, and how have they built it, and all of that. How's architecture, for instance? Is it scalable? Is it not scalable? The other thing that we also tend to try and solve, depending again on the stage of the company, is the ESOP pool. Has the ESOP's been granted? Is there a structure? What is the thinking? If it's very early stage, then it's okay. But if it's a Series A, we probably want to put that into the cap table. I was saying. So those are the two things.
Yeah. And just to add from my side, I think another thing that we should focus on in the diligence is the viability, not the viability, but the legality of the business structure. Because there are new businesses coming up, day in day out. Like we had this peer-to-peer lending platforms that came up. Then there are fantasy sports, companies that are now doing business in India. Then the existing businesses, they are innovative models that are being used to conduct that business, right? And unfortunately, the law cannot catch up with this fast-paced industry where the new business models are coming up. So a lot of times it's very important to take a view, whether especially when you are investing from a foreign jurisdiction. From an AIF perspective, I think that's one of the advantages you have, that the restrictions under the FDI policy, which applies to foreign investors, does not apply to an AIF as long as your manager is Indian owned and controlled, right? From that perspective, so it's very, very critical to understand the business and then do the check whether it is permissible to do this business under Indian laws, right? And so diligence, we also look at it as a way to understand the business of the company, how the company actually operates, right? And see, funds are not, their only role is not to give the capital, right? That's how generally it's projected that the founder has raised so much money from this one, that one. But at the end of the day, they're bringing much more to the table, right? Which is their expertise, their experience in either running company in their future ventures or advising companies. So there's a lot of value add that you can get from the funds in terms of best practices that you can bring into the business. And for that, it's very important to understand how exactly the business is operated at each step, right? So I think that should also be kept in mind. Yeah. Okay. Then so I think due diligence, post diligence, once everything is fine, we move to the documentation stage, right? Now documentation, in terms of, it has become quite standardized to say, for a VC round to a PE round. Obviously, from funds to fund and company to company, there'll be negotiations, there'll be, slight changes in the documentation, but the basic structure of a documentation remains the same. And this is something we I think, took from developed economies, the concept. So, it's still being molded to suit Indian requirements and, Indian regulations. But so my question to Abhinav in this regard is, as you said, at the term sheet stage, don't, over-optimize, right? Should that happen in the documentation stage? And if yes, to what extent?
So that's a tough one, Parag, because see, if let's divide this into early growth and say public or pipe, right? Now, I don't think over optimization is feasible at all. To be honest, over optimization is not feasible anyway. But at a seed stage, to say bring in a clause and say that you will provide me an IPO exit in 5 years is, I mean, it doesn't make sense. Right?
It's not happening.
Yeah, because I mean, the company, the founder knows he's just figuring out what he's doing. We know he's just figuring out what he's doing. So to put in an exhaustive exit clause saying, hey, give us an exit in 5 years, there are certain factors which come in. Say, for example, if there are existing investors on the cap table, those are different dynamics which will play out. But otherwise, again, to solve for everything and cover every corner case would just drag things to a level where it becomes frustrating on all sides. Yeah. So, I mean, at least the way we approach is, we have our learnings over the past decade of investments, and we are very transparent in saying that, see, while this may seem a little unreasonable. I can give you an example of a call I was having on the way here. We were negotiating the non-compete clause, which was to be in place 2 years after the founders quit the company. And the founder's fair ask was, please limit it to India, where the company is functioning, or say that it will be applicable only to those jurisdictions where the company is operational, which is a fair ask. But now we've had a learning in one of our past investments, where the founder left the company, incorporated another entity in US, where the particular investee company was not operational, and is running the business from there within that jurisdiction. Now, technically speaking, he's not in breach of the non-compete, but it beats the whole purpose of non-compete, right?
Yeah.
So, a bit of sensitivity, and this is where I feel founders need to be a little more trusting, in how they are approaching it. There are learnings which all funds have had, and some of these clauses may look a little more onerous, perhaps some of them are. But then we invest in a fiduciary capacity, so we need to have some things. So, if that balance can be arrived at, and that's something which can't be done only by the lawyers, I think. The investment team, that rapport needs to be there.
Yes.
And once that balance is there, documentation flows through. If it's not there, then we've collectively also experienced,
Yes.
it becomes a very, very painful process.
Yeah, thanks. So, Vinay, just to, what Abhinav mentioned, like, for example, if a founder or a company has raised few rounds, right, they already understand, because, when they would have done this the first time, they would have understood what they're signing up to, right? But for people who are raising money for the first time, and I have personally faced that, with promoters, because these are nuanced concepts, right? It's not easy to just ask someone to sign up to these, right? So obviously, as lawyers, we focus on, trying to get the deal done, but we have to protect our client interest. So what I've seen is a lot of times, wherever lawyers don't agree, everything becomes commercial. Whether it's a legal point, also it becomes commercial, right? So how do you give comfort to promoters, in terms of what they are signing up to?
Right. It's a good question. I think everyone needs to be practical here, right? And set aside egos, and whether it's a large fund which does not want a small entrepreneur who's not done any other business before to dictate things. Neither should it be flipped the other way around, right? An entrepreneur shouldn't say that, what, this is my business and this is the way I'm going to agree to these terms. So I think set aside ego. If both parties are really interested in actually doing this, there may be some hurdles, but be practical about these things, right? So to specifically answer your question, I think you asked how much time does it take to go from deal sourcing, or the, let's say, initial liking of the deal to actually doing a term sheet. And this is something a lot of funds do, and especially a culture that's been there in Silicon Valley or in New York, and I think it's come over here, is that we spend a lot of time with the founders over dinner, lunch, whatever, just getting to know them very well, right? At some stage, they need to start having trust. Yes, you will be negotiating on opposite sides, but soon after that signature is done, you're going to be partners for, I don't know how long, 7 years, 5 years, whatever is the time frame of that investment and horizon, right? So I think they need to start trusting you somewhat. I'm sure they will still not do it. And typically, one of the things at an earlier fund, a partner told me the first time, he said, is to be on the board basically means that the first call that the guy does, or the woman, the entrepreneur does, is if they have any problems, and even sometimes personal issues, and especially if it's a lone founder, right? They don't have co-founders. That first call, whatever time of the day it is, it should be to you, right? That's when you've sort of established the trust, and there is some meaning of you being on the board. Practically, how much can you build on that? I don't know, but we managed to do that in several cases, right? Where they do call us if there's any issues. So if you are able to build that trust over those 2-3 months and sort of spend a lot of time, sometimes these kind of things do become easier, where you say, what, trust us, we are not here to screw you, right? We are here to have a win-win situation. Like, so that gets you over some of these hurdles at least. So.
Great, I think that's very helpful. So, as I had mentioned earlier, that transaction documents have various provisions, from governance, like having a board seat, to restriction on transfer of promoter shares, because as as Abhinav and Vinay both have mentioned, the investment is not only happening in the company, but also in the promoter, right? So the funds want to ensure that the promoters don't, leave the company, because the company is them, especially at an early stage, right? But the key provision, as because they are in the business of investing, right? Once the investment has gone in, it has to come out at some point of time, right? So a typical transaction document provides for various forms of exit, like ideally that works best for everyone is an IPO, or you have a third-party sale, whether to a strategic, non-strategic, buyback option,
Or
or
a
a
soft
drag,
bank sale.
or a soft bank sale, right? Yeah. Okay. So, but
that can be probably put as a separate category.
that can be put as a separate category, yes. But so so many things are put in the documents. But and question to both of you: do you see it actually playing out that way, right? Like, because if you see in the Indian market, IPOs are far and few, as in especially for a company which was incorporated in the last, let's say, 10 years. There are few examples where it has happened, but I think that has happened because of in the sector they are operating in, infrastructure, where it's easy to to grow in size compared to a company involved in, let's say, doing some artificial intelligence or something like that. Right? So if you can talk about some practical aspects of an exit, and if any issues that you have faced, right, from during those exits.
You want to go first?
Anyone, as in
I'll take
both
it.
of you.
So first of all, IPO, I'm hopeful that over the next few years, that changes. I know for a fact that, SEBI and other regulators are also actively trying to work on and create a platform. There's a lot of work to be done, but at least that consciousness is there, even with the regulators.
They've set up a committee for that.
Yeah, they've set up a committee as well. So, hopefully that reaches somewhere. The SME exchange has taken up fairly okay. So hopefully similarly we can have something, here as well, and that should lead to an aspect which is missing. But otherwise, it's generally either a strategic or a growth big P guy giving an exit, and everything from the term sheet till documentation which we discussed, the compliance which needs to be done, all that eventually culminates into this one moment in the life of the company, right? And lagging on anything in all those previous steps leads to a problem. One of our recent exits, there was strong intent, everyone wanted to do it, documentation full throttle, diligence was happening parallelly, and they just realized for one angel investor who was probably the first set of family and friends who had put in money in the company and who was a non-resident, they couldn't find a particular investment number, right? And so we said, okay, it's a small thing, it'll get sorted. Once people dug in deep, people realized that the money had actually come from his personal account, but the shares were allotted to an entity through which it invested. Now, this was just either mopped up or ignored, and that required compounding, that required going to RBI. Once they went to RBI said that, okay, if this has happened in this case, we want to open up everything. The closing got delayed by about 4 months, and there were several occasions in between when we as sellers were very, very pensive, because the purchaser, and rightly so, right, was asking, how can this happen, and how do you I want to now really do a deep dive diligence on every aspect, because the purchaser was a strategic buyer and they can't afford to have these things. So this is one instance of a practical example, and so we burnt our fingers this way, right? It went through, thankfully. So at least now we've tried to sort of bring in a mechanism through which we have a panel of company secretaries, CAs, in all sort of brackets in terms of costs, and we strongly recommend to all our portfolio companies that, you're not at a stage to have a CFO, fair enough. We are not saying go hire a CFO. But impanel one of these guys, go, ask them to come maybe, 3 days in a month, look at your books, see if everything is in order. Because as you grow, things are only going to get more difficult. And something which is not sorted at an angel stage can really come back and, bite you at the time of exit.
Correct.
So, that's one aspect. The other thing which I've experienced to sort of become, a bit of a pain point, when I mentioned about ESOPs, right? Now, typically, they are provisioned for, but not really, it's not like a trust is created in most cases. Now, where does it go? Because, sometimes as big as 2%, 3% remains unallotted.
Yeah.
And that's something which always becomes a discussion point, whether founders should get it because the founders worked for it, whether it should be equally distributed. But that's a discussion. That's actually a commercial point,
Correct.
So, these are the two instances which sort of come to my mind, which I've seen in my personal experience. But bottom line is that is the goal, That is why everything else is being done.
Correct.
Yeah, just to add to that, so obviously all of these things are thought through in theory, put on paper. You want a high-profile exit through an IPO. Fair question: does that really happen? Everyone sort of knows that most of the deals that get exited happen through strategic M&A or larger PEs. But everything is thought through, and I would say that in tech, maybe it's true that there haven't been too many of these. There haven't been any 2 or 3 IPO exits, but more or less it's been strategic and even more so PE buyers. But on the private equity side of things, even in growth equity, the IPO market has just been amazing these last couple of years, especially in financial services, pharma, healthcare, and all of that. So even companies which are, let's say, 600, 700, 800 crores revenues, which you would not have thought maybe are IPOable, are sort of going through that. Consumer brands, with, of course, all of these have decent profitability metrics, right? That in our country, IPO regulations state that profitability is something that needs to be there and very, very strong at that. Even for the SME IPO, actually, you do have profitability metrics. The good part about the SME IPO is once you get in, transitioning to the larger IPO market is not that hard. You can still do it if you maintain certain standards. So I think that is still a very plausible exit, and it's happening very, very real for the growth equity and the private equity, or rather the non-tech sort of sectors. I think it's tech where things have still got to be figured out. Even in tech, it's more the internet industry, I think, where the profitability is an issue where that needs to be sorted out. But there again, you still have the Chinese companies, the large Chinese companies, the large US companies. So exits are probably getting less of an issue as we go along. If you'd done this panel 4 years back or 3 years back, people were really worried about it. I think it's sort of lessening now because of the influence of SoftBank and all of these other guys. Right? So that's a good trend. So I think whatever document language that we're putting in is actually starting to become realistic in that sense, right? So.
Great. So, you mentioned, in terms of an IPO, we discussed the exit. So, one thing which I want to discuss, maybe not really from a documentation perspective, but more from a structure perspective, is, this concept of flipping, right? Externalization, where you say, okay, I want to move the company from India to Singapore or Mauritius, right? And the reasons generally given for that is, you get better valuations in those jurisdictions, or it's easier to get an exit. So, Abhinav, just a question for you that, do you think these are the ideal reasons or the correct reasons to flip to let's say, Singapore? Right?
So, see, industry is maturing, right? People are becoming more and more savvy, and another example, so Kalaari also has a seed initiative called K-Start. And we do very early stage, small ticket investments. So these guys had come and they had a great idea, and they had already set up something, and everyone was very, very interested. So we went ahead, gave them a term sheet, and then when I sat to discuss with them, they said we have a Singapore company, and I asked them why. you know. Are you doing anything out of India? I said, no. Is there a plan to do anything out of India? Maybe, you know, in the future. Okay. They're not really an IP heavy company. It's more sort of an, you know, operations driven kind of a thing. So I asked them, why did you go to Singapore? And they had, you know, similar reasons. Let me take them one by one. Okay, better valuations. I don't think so. There is not a single fund out there who wants to have an exposure to India and has a condition that no, I'm not going to invest in a India company. And to be honest, a lot of funds are solving this problem for them to get the money at one place, funnel it into India. That structure is, you know, funds are structured in a way so that these problems are taken care of. So whether to flip or to set up outside India has to be a factor based only on pure business or operational reasons. I don't think any fancy structuring is necessary for you to get a better valuation. Okay. Now, there's one sort of legal angle there, which I think is a consideration, which is IP protection. You know, India is developing and coming up there, but I think IP protection in say Singapore or US, I would still say is stronger. That can be a valid justification, but then you have to be that kind of a company, you know. You have to be that kind of a company which is just absolutely developing something, you know, which you're going to go and get a patent on. Okay. So apart from that, it has to be purely business and operations driven. There's no reason to externalize if, you know, you are just because you think there's something. Also, you know, it's sort of become, India is changing, right? We are moving up the ladder in ease of doing business. There are several initiatives out there, even for IP for that matter, you know, there are several initiatives which have been taken. So, you know, we are getting up there and we will soon be up there, right? It's too much of a hassle to have a foreign structure unless it has a business reason to it. So I think it's prudent to have an India company if you are working in India, unless you have strong reasons to really be out of India.
I think just one last question for Vinay, and then we can move to question answers. So, you know, any advice you'll have for the audience, especially for the startups, what they should include in their pitch deck when they go to a fund for raising capital?
Right. So I went through the criteria that we like to see, right? You know, starting from market, what is the problem statement that you're trying to solve, right? And who's doing what are the incumbents doing if there is any such thing in that space, and then how are you sort of approaching it differently? To me, that has to represent sort of the bulk of the presentation, right? I'm talking about a pitch deck, obviously, because that's where the passion of the entrepreneur is going to come through, the fact that he or she has spent time thinking about the domain, they thought about how to solve those problems, all of that stuff, right? So market, problem statement, pain point, whichever way you characterize it as, right? And then, you know, the tech or the product solution that you have, the team, right? And I'm talking specifically about early stage. Obviously, this applies very differently to a growth equity situation. And then how are you looking, is there a revenue model there? Are you even trying to monetize it currently? Is it not? What are the key sort of metrics, you know, monthly active users, daily active users, what is it in that particular space, all of that. But I would say the bulk of it has to be about the problem statement, the pain point. And I think obviously we want to see the passion in the entrepreneurs, right? There isn't anything on the ground. You want people to put capital, and this capital, all said and done, funds are still only custodians of capital, right? It is someone else's capital that we are trying to deploy smartly and make money for them. So you want to make sure that you demonstrate the passion and you've thought through all of the things. And it's not that you'll be able to solve everything, right? We completely get that. It's just that you need to have spent much more time on it. If I can, let's say there is a healthcare informatics startup, and if I can demolish your investment thesis in 20 minutes and you are the entrepreneur, I'm the generalist investor, that's not a very good sign, right? So that's sort of where you have to think about these kinds of things and come back. Any other issues, like for instance, maybe you are a co-founder who's very strong in business, but you don't have anyone who's taking care of technology. Those kinds of things we can plug, but the main elements still have to be there, right? So I think those are some of the ingredients of a successful pitch deck. So,
thanks, Vinay. Thanks, Abhinav, for the responses. So we can open up the session for questions if anyone has anything to ask.
Been working in a bank and also venture capital. I was doing real estate. We got legal and we got people who have done, fund. The problem always is till the money goes out of your gate, the other party, you say drinking, eating, friendly, everything goes on. The minute the money goes out, that is the end of it. You can have any amount of agreement. I found it in many cases when you deal with individuals, proprietors, fantastic till the money comes into them. After that, whatever agreement you have, they have their own style. You may be on the board, you may say that they have to give you this report, that report every month. They will not do anything. After the money goes out, what do you do? And particularly as, venture capital, you put the money in, you have to wait only for the exit. And this is the case with any number of cases I've seen. Forget about as a bank, of course, you got people like. Example is Vijay Mallya. You are given the money, and after that, what control do you have? You can put anything on your legal documentation. You have to say that they have to submit in writing every month about the progress. You have to call a board meeting once a month, or once in 3 months, or once in 6 months.
Yeah.
But it's all namkevas. You can't go explain to the guy how to run the company. Right. And this is the case, my personal experience, with N number of guys. They do it their own way. Like, for example, in real estate, I dealt with number of companies. You as a professional guy, you tell him that, today you construct a high-story building, you have to have metallic scaffolding and things like that. They will still use bamboos and things like that. It is unbecoming of today's age, and I'm becoming a partnership with you. They keep on cutting corners as they want. You can't change them. So what do you do in such cases? And I'm sure there are other people who are funds and all that.
Yeah.
What is your experience with people? There are very few people, who litter in spirit, who follow and do things. But this is my experience. What is your experience in your funds when you are, till your money goes out, it's fantastic. After the money goes out, Desai, you have to only keep waiting and praying.
I think it's a fair question. I'll give my perspective.
Yeah.
Sure, you have a much deeper perspective. Can I ask you a question in return? How many days a month did you spend with any of these founders?
Post the
companies,
investment.
post the investment, of course.
Yeah.
Pre-investment, post investment. What was your interaction with these guys?
Sorry?
How many days a month or a quarter, or did you just fly in and out for board meetings, or did you actually spend time on the ground with this founder?
We can do it for 1 month, we can do much more. But point is, we are also doing many other funds and we are not full-time people working in the company.
Exactly.
And we don't want to be doing that.
So, look, our approach is very simple, right? If I want to speak about our fund, Stakeboat Capital, we will probably not look to do more than 6 to 7 investments, right? And the reason being, the investment and all of this that we talked about is only the nice part of it that lasts for 3 to 6 months, right? And then there's a 5-year or 7-year or whatever time frame to exit. That portfolio management time is really where we put all the sweat and toil and everything, right? And typically my outlook is, I need to spend at least 1 day a week or 1 day in 2 weeks with these companies, right? And when I'm saying that, it's not board meetings, it's not monthly reviews or anything. Just going there, sitting in the office, and I don't even care if the CEO is not there. I will actually go when the CEO is not there, right? And just go understand what the market is. We do our own market study, we independent. So the CEO might be saying, you know what, this consumer brand market is growing this way, 25%, so we'll go and find out, right? So we have to put in a lot of hard work. Despite all of that, he might still do what you say, right? That may still be possible, and that legal enforceability part, maybe he's better equipped to answer. But in terms of portfolio management, I think that is what we have to do. Until you get to a stage where you know that this person can handle it, and still you need to be in. Because like I said, right, honestly, we are only custodians of capital and someone else's capital. So we need to be very, very careful, even more careful than with our own capital, right? So for me, it's about spending a lot of time understanding and seeing the red flags early on, right? If the red flags are that this person was just doing this for the investment and then there is going to be a parting of ways or parting of thoughts, we need to step in. We actually put in quite a lot of clauses. We have pretty severe clauses, and this, I'm not talking about early stage, I'm talking about little more mature companies, where if the performance drops by a certain percentage, you know, I'm not even talking about serious red flags, right, frauds and all of that. I'm talking about performance, underperformance by 20%, then there'll be certain rights. And again, good question on enforceability, but we put all of that in and start pushing these people very early on. I think the idea is also to look at early warning signs and be very close to these companies. So there's no magic bullet, but that's what I think is.
So, you know, let me divide this in two parts, okay? Say the kind of investment, the stage of investment, and the kind of industry. Now, if you're doing, if you've partnered with a real estate developer and you've written a, you know, 400 crore check for a project for which the developer has that's 40% of the capital he needs. Based on that 40% capital, he's gone and raised the remaining 60% as debt from a bank without any of his skin in the game. Then obviously, you know, it's a difficult scenario, right? But let's talk about early stage, or you know, maybe till series B, C also, right? These companies need to keep raising. The first 2 million from me is enough for 18 months. The next 10 million is probably enough for another 18 months. The next 50 million is probably enough for 2 years. But that guy needs to go out there every 18 months, 24 months and raise, either from me or from someone bigger, right? Now, when you have to do that, you know, it's a small ecosystem at the end of it. There are only so many people who can give you money. If you have swindled money, or if you have, you know, now that's all I want in my life, I'm running away. I mean, very few people think like that, right? So that's covered. Now, at the other end of the spectrum, and you know, you talk about real estate, first of all, that sector itself has its own challenges and the people who are, you know, involved and run it. If there is skin in the game for the promoter and the founder, then some amount of commitment from their end can be seen because there is skin in the game. And you know, I think very rarely are there just pure equity real estate investments. Most of them are structured investment. There is a flavor of debt, maybe through an NCD instrument or a CCD instrument which is brought in. So your protection in terms of the security which you have taken, and in most cases I've even seen personal guarantee. I will come to the enforceability part, but you know, in terms of at least building in the protections, is the best which can be done. Now, enforcing a personal guarantee in India, I've tried to do it once. I have been a part of a big portfolio management company in the past which did only real estate. And enforcing a personal guarantee in India is a nightmare because you know, there are all sort of things which come in. But enforcing a corporate guarantee in India, and now after the IBC, you know, is a much, well, I won't say simpler, but a better affair. So I understand your question, and I understand there are challenges, but it's being worked upon. You know, the new insolvency code has really made it very, very viable. In fact, I was speaking to someone from a private sector bank in the legal team, and they say that defaulters are actually coming to banks now and saying that, okay, let's restructure. When it used to be the other way around earlier, you know, they would just default and sit and say, sorry, I can't pay you. But because of the new insolvency code, it's the other way around, because now they know, the consequences are far, far greater and the remedy is far, far simpler. So, I think a culmination of these things for us, as Parag said, buyer be aware, for us to be as conscious of the risks as possible, and that along with other remedies which are available, I think situation is not as bleak as it used to be.
But this personal guarantee and all that, does it apply to even you going in as equity, right?
No. So, but I mean, I'll at least we don't fund 40% of a real estate project,
No, what I'm saying.
But if you are a real estate fund,
like Uber, for example of Uber, I mean, like many people have put money and all that. Supposing they misbehave, drivers do this, and you do something to take care and all that. But the money has already gone in.
So, very pertinent example, what's happened, right? The founder is actually out of the board right now.
Yeah.
The founder is actually out of the board, right? So it would be incorrect to say that there is no ownership or consequence. There are consequences. If you can be kicked out of the board of one of the biggest startups in the world, then these black ants on a white paper which we write do have some meaning, right? Otherwise, how would that be possible?
And I think just to add to that, Uber is a good example. The capital that generally goes in, and we tend to play it the same way, is that it goes into the company and is used for things, right? And the reason we stay very close and we have monthly metrics and all of that is to follow what's happening with the use of capital. And a lot of times what we do is that, let's say there is a $10 million round with the company, we don't even infuse 10 million, right? We have tranches. Like we'll put in 2, you get me the metrics I want, and then let me give the rest next 2, right? So we do all of as much control as possible, right? So even if someone wants to embezzle money, it's going to be harder to do that. And at the end of the day, okay, the company might be valued at 100 million, he might misbehave and run away, but he has only paper money. He really doesn't have much cash over there, right? He has to exit that company to do that, and then he obviously has to come back to us and talk to us, right? So there's other kinds of controls, checks and balances there. So.
Someone in the back.
Hi. Can you hear me?
Yeah.
Continuing with the discussion here. So basically, when it comes to legal framework that governs alternate investment funds, I would like to know how is if from a general reading of the statute, would you define it as more facilitative or would you define it as more precautionary? And considering the fact that it's high risk asset class, does the regulatory framework allow for a lot of flexibility? Or all the terms of engagement seem to be more specific in nature, 2 parties entering into a contract. So how is the general overarching legal framework when it comes to governing of alternate investment funds?
So, sorry, just to can you repeat your question?
Yeah, so
Broader level.
so basically I was trying to understand the legal framework that governs alternate investment funds. So
Okay.
it's a nascent industry, like as per our discussion.
But it's a regulated industry.
Yeah, so how regulated is that space, A? And if you see the statute that governs it, like when we read a statute, we would see, like as you said, does it take the precautionary stand or does it take a facilitative stand to allow such investments, like to allow the alternate investment space
Correct.
to
So see,
prosper?
it's a mix of both. Now, as I mentioned, when you asked how regulated it is, you cannot start an alternative investment fund till you have a registration with SEBI, right? And before giving the registration, there are certain parameters that SEBI checks, right? Look at the certain disclosures you have to make, right, with respect to raising a fund, and then there are quarterly reportings, right? So there is a regular check on what you are doing, and that is being monitored at a regular, on regular intervals. Now, in terms of precautionary or facilitative, obviously it has both approaches, right? Because it is a pooling vehicle, right, where people from different places are pooling money, which gets funneled into different companies, right? SEBI is mindful of the fact that it's third-party money, right? So in terms of your money laundering aspects, or the kind of investments that you're doing, and the kind of exits you can get, all that is monitored by SEBI, And facilitative, obviously, because if you see, like, I think the biggest advantage today of incorporating an AIF is bypassing the FDI requirements, right? So you can actually, foreign investors can pool in money in an AIF, right? It can be 100% money, can be from foreign investors, as long as it's Indian owned and controlled, the manager, right? You can invest in any sector, like you can even buy a retail chain if you want to buy, which is a big problem under the FDI policy, where retail investment in retail trading has serious restrictions and conditions attached to it, right? So it's a mix of both, I would say.
Hello, this is Ashok here.
Yeah.
Of your portfolio companies, right, after your investment, let's say the performance goes down on a consistent period of time. At what point of time you take a trigger to say pull the plug off? What is the matrix you follow, or what is your thought process for your portfolio based on your experience?
For me?
Yeah.
Depends again on the stage of the company, right? If it's early stage, then I would say the rope is pretty long, because let's say it's an AI investment, we don't even know how the market is going to evolve in India. What sort of segment, subsector of AI. So metrics would be more harder to define, right? A lot of these commerce plays, we will say it's monthly active users, daily active users, number of users that you have to get, paid usage, and then can you get to a revenue stage and things like that, right? If it is more growth equity, then it's easier, obviously, to define. There's already a business. So typically we tend to have a certain, management would present a business plan for the next 5 years and clear focus on the next year or 24 months, right? So we can say basically, this is your EBITDA margin. And then we can talk to them about, is that an aggressive budget? Is that a defensive sort of thing? And then sort of agree on something that everyone's happy about. And then you say, if there's a 10% underperformance or a 20% underperformance. Typically we give them, even in growth equity, we give them about 2 to 3 years, right, to sort of get things right, because there's a lot of reason why they are presumably looking at growth equities, because they want to grow very fast, and therefore they may not be able to focus on profitability for the next year or so. You might see some dips there. So you've got to give them some time. So, and also when you say pull the plug, investment is probably gone in already, right, in those 2, 3 years. So you will still need to support them, right? You cannot pull the plug and sort of walk away. Your money is already there. So you need to sort of work with them. And if it is an issue of market construct and market is completely changed, then it's fine. It's understandable. You work with them. Look at something like a Snapdeal, right? They pivoted the business model. There's a number of companies like that, right? So we tend to work with if the team is really good, then you tend to work with them and do that. If it's other reasons, if it's obviously illegitimate reasons like fraud and all that, obviously then you look at legal enforceability very quickly. But generally it tends to be on the market or the business, or maybe they're struggling because they need another strong CFO or some strong operational person, so we tend to sort of hire people. So we do give them a long rope in that sense. So it's a 5 to 7 year exit period typically. So 40-50% down the road is when we sort of say, what, let's get serious. There is serious underperformance, of course you might pull the plug sooner. But
so just to add on to that, there's no real pull the plug. I mean, the company is still there, the money is still gone, you're still a shareholder. So, it's not a switch which can be turned on and off. Even if the company is defunct, it still needs to be wound up. You still need to, sell your shares to someone, maybe back to the founders. So, it's serious business even to wind down a company. To incorporate and grow one is definitely challenging, but to just completely wind it down also is something which requires serious effort.
And from a fund perspective, let's say we've done 6 investments, 3 of them have done very well, 2 are underperforming. Then you'll try and find how can you exit that company with sort of minimal damage, right? Can we get our capital back? Is it going to be a write-off? So you sort of come up with these sort of defensive exit strategies, right? Can we sell it to someone who's another larger PE who can then combine it, consolidate with their existing sort of companies? You think about all of these things, right? So that is when you say pull the plug, that is pretty much what it is. It's how do we sort of exit from these with a decent enough return there, so, or minimal damage, let's say.
Any other questions? Okay, thank you everyone for attending this. I think this was very interesting. And thank you Vinay and Abhinav for taking out time and discussing this.